Mark, great to see you.
All right. Good afternoon, Kenny. Great to see you too. Appreciate everybody joining us today for our third installment of investments. And happy to see some familiar faces joining us and hopefully some new ones as well. So let's jump into it. And just a reminder of what we've got going on with our ongoing series. Every Friday, we've been putting out what we call Bear Facts Friday. And we've been getting some good feedback on that. So we hope you've been enjoying it. What it is kind of some quick hits from the week. So essentially, Kenny filtering out some of the big picture news items and the headlines that you may be seeing. And then I've been offering some investment perspective, and Lisa has been rounding it out with tidbits of wisdom. So I think the three of those items combined have been a big hit for a lot of people. And then in addition to that, we've been putting on our webinars every other week. We actually skipped last week just because it was right after the 4th of July holiday and figured some people might still be out. But those are the two things that we have been offering this year, especially during kind of the tumultuous first half of the year. And it all gets back to what we call the financial success matrix. And everyone has one, even if they don't quite know it yet, or if it's certainly still a work in progress. And here's what it looks like. Essentially, starting at the bottom of the pyramid, talking about financial planning foundation concepts. From there, we talk about investments, which is what we'll be going over today. And then at the top of the pyramid, getting into some more advanced planning type topics or sophisticated planning topics. And this can come in various forms or fashions. So we've been working our way through the pyramid every other week and then just recycling that. And so here we are. So today, let's do a quick recap of what we talked about in investments part one and part two, because this topic in particular certainly builds on it on itself. We've got to lay some of the basic groundwork when it comes to investing, and that's what we did in part one, where we talked about what is the difference between a stock and a bond, and what other asset classes like real estate or commodities or precious metals or even fine artwork, what other things exist out there that one could choose to invest in. And then we talked about, well, there's a risk return trade-off with any sort of investment out there. There's no free lunch. And so how do we determine what that profile looks like in terms of the, not necessarily boom or bust, but how much risk reward are we looking for and are we willing to accept during our investment journey? And then in part two, we got into this idea of the market. And we've got that in quotations because we talked about it can mean many different things. Some people may say the market and refer to the S&P 500, which is just 500 of the largest companies in the United States alone. Then there's an index like the Dow, which is 30 stocks, and the NASDAQ, and so on and so forth. So different ideas of what the market is when you may be looking at your own accounts or talking to your friend or your neighbor, something like that. And then we closed out part two with some general ideas of how to invest. And what we looked at there was the conventional approach to investing, which may be something along the lines of picking individual companies or securities that I like and investing in those, and then excluding other ones that we don't like or we don't want for whatever reason. So that was the conventional approach versus the indexing approach, then gets more into holding baskets of securities. And there can be any number of parameters around what that basket looks like, but ultimately it gets down to having some rules involved to help us objectively indicate here's what we're going to own, here's what we're not going to own. So that's a brief recap of parts one and two, but we encourage you to go back and take a look at that.
Mm-hmm. Yeah, take a look or call us as well if you want to discuss or try to give yourself a better understanding about how you should invest. I mean, because the idea is to build one upon the other. I mean, the first is, and a lot of people we take for granted don't really know what the difference between stock and bond. They know the term, of course, but do they really know what you're getting? Then building on that to understanding the market, and then once you know what market even is, how do you begin to build a portfolio? And then that goes into really today asset allocation. It's the number one uh, determining factor of whether or not you're going to have a good or bad return over your investment experience. Has much less to do with which stocks you buy and which ones you own, and more to do with which how your overall allocation looks. Stocks relative to bonds is going to be the number one determining factor of your return over enough time. And then we'll also get into sort of the global landscape, because it's the big world. The United States has 300 million people. There's 7 billion people in the world. There's a lot of companies that aren't in the United States. And how do you build a portfolio that potentially includes some of those other companies as well? And then looking at what is an asset class? It's a type of investment that is in a certain category. So large cap, small cap, large cap, big companies, small cap, smaller companies. Understanding what can you expect to get. If I invest in something, what is my expected return by putting my money in that? And what is the risk associated with trying to get that return? Because an investment might have an expected return of 12%, but there's a lot of risk to get that 12% return. What is that risk? Is that something that I can live with? First deciding factor. Second deciding factor is, how does that expected return of 12% react with my other investment over here that has a expected return of 6%, but has less risk? And how do we combine those together so that we give you the highest expected result with the least amount of risk from a mathematical, objective perspective? That's correlation is the last part.
Yeah. No, so I mean that's spot on right there. Is let's just take it as the simple stocks versus bonds, two different asset classes. Stocks in general have similar behavior, but then as you said, within the realm of stocks, they can behave differently, whether you go for large cap or small cap, whether you go for value or growth or any number of other metrics. Another asset class is bonds, like you said, but even within that, we've got to look at, well, what is the taxability of those bonds? Maybe corporate versus municipal as an example, or what is the term or the duration of those bonds? So you can see how you start to branch out this little web looking at different asset classes. And then understanding those three characteristics surrounding each one, that helps you put together a viable portfolio that, as Kenny said, will hopefully give you the best return over time relative to the amount of risk that you're willing to take. So understanding what's the expected return of the individual pieces, what's the standard deviation, or essentially think of it as volatility in a sense, and then how are they all correlated? Got to understand all of those things.
How they work together. I mean, think of it like one analogy I was just thinking up here is like, it's like a football team and everybody's got their role, right? On offense, you have 11 players on the field, same as on defense. And one great player by themselves, you can't win the game. You might have your most important players, if which probably be the quarterback, might have the greatest influence on the overall outcome. But him by himself isn't going to win. It's how everybody works together as a unit that gives you the best opportunity to win. And in this case, gives you the best opportunity to make money. So it might be, you might have your star, which is in the case of our clients' portfolios is going to be the, large cap US stock market, but it's how those other pieces all work together to give you the best result for the least risk.
No, I love that analogy. So I'm going to try and build on it. I don't know if you're ready for this right here, but in the football analogy, everybody's got their own role, and you wouldn't have a team made up of 11 quarterbacks or 11 wide receivers. I mean, even if they were the greatest of all time, even if you had, Drew Brees and Tom Brady and Peyton Manning and, go on down the list, if they were all on the field at the same time, I would venture to say they actually wouldn't win the game, believe it or not, because you need those different players. You need those different role players. Peyton Manning's not going to be down there catching passes, and Drew Brees isn't going to be snapping the ball at center very effectively anyways. Right. Yeah. So you've got to have the different pieces that come into place.
Yeah, even better. That's what I was trying. That's what I was trying to go. Yeah, everybody plays their own role, and they have a purpose on the unit. And it's not that all we're trying to do is just get the best. Yeah, exactly. I mean, just exactly what Mark said. Get the best quarterback because you can't win with 11 quarterbacks. You need different positions that they each fill their role and responsibility, and they do it well. And then it's but not only that, but how they all work together to give you the most likelihood of success.
So hopefully that sets the stage a little bit for what asset classes and asset allocation ultimately mean. And then the next step in that is to understand, well, what is that right mix, or how can they be mixed? And really the honest answer is there's no one right mix for everyone. I'm sure everybody out there has heard of, okay, the 60-40 portfolio, because it has carried itself through many decades of investing, and many people may have utilized it themselves. But ultimately, each investor has their own correct mix when it comes to what their allocation should be. And so on this chart right here, we see a period going back to 1988, so a little over 30 years now. And just to help visualize, what does that look like when we think about the three characteristics from expected return, from volatility, and from correlation? And so you can see, working from the top down, if we have a 100% stock portfolio versus now a mix 75-25 or 50-50 or all the way down to cash, essentially, you can see what those metrics look like for you, the investor, at the end of the day. And one of my main takeaways is that, look, you can have a great return either way. It's just about what can you stomach as an investor, and what is right for you relative to things like your goals and your time horizon and your expectations.
Yeah, I mean, ultimately, and Mark and I have told this to a lot of people, probably even listening here, the ultimate success that you have as an investor is, first, it's going to be determined by your asset allocation. Number one, first and foremost. So at the beginning, understanding the risk tolerance that you actually have and building the portfolio from there. And then second most, or really 1A and 1A1, is your ability to stick with that asset allocation. That's going to determine your result over given enough time. And the more aggressive you are, if you have a long enough period of time, you'll probably end up with more money. But to end up with more money, you've got to take on substantially more volatility, more risk, more drastic up and downs. And just because you're in equities, or you're 100% stock portfolio, so the most aggressive portfolio, does not mean you're going to have a better result all the time. And if we look at this chart that Mark has up right here, essentially close 100% stock portfolio between the years 1988 and 2008 had the same rough return as a 25% stock portfolio. Since then, it's taken off, and you've got a substantially higher return by being invested in 100% equities. But I don't know about you, 1988, 1998, 2008, it's 20 years time, and you would have been just as good have you invested in a portfolio that was 25% stocks, which is a super conservative portfolio. So it's just because you're taking the risk doesn't automatically mean you'll get the reward. In investing, it's just a marathon. And it's hard to say because, our lives go by, and, we look back, and 20 years ago might seem like yesterday, but in the midst of it, it goes by slow. 6 months time, you're comparing your portfolio to whatever it may be. I mean, feels like a long time. That should be a good enough, enough amount of time to determine whether you're doing a good job, it's the right portfolio or the wrong portfolio. In the grand scheme of things, I guess I got football on my brain today, but it's like the opening kickoff. I mean, it literally means next to nothing. Might even be the coin flip. We haven't even started the game. And that's where you're looking at a lifetime of investment experience as the full game, 50, 60 years of investing money for a prolonged period of time, when you can start to really reliably say your 100% stock portfolio will do better than your 40% stock, then will do better than a 40% stock portfolio. But it takes that kind of really time. As I just showed you, here's a 20-year period where a 25% ended up the same as 100% stocks.
Yeah, and that reiterates a point that we talked about, and I can't remember if it's part 1 or part 2, but it's so important. It's vital that you understand that, is that in investing, a long time is not a quarter, it's not a year, it's not even a few years. I mean, long term, really 10 years or more. And anything shorter than that is just kind of blips on the radar, quite frankly, in the grand scheme of things. Now, I understand that can be hard to kind of accept, especially along the way, or depending on where you are in your investment journey. But it really is just something that you have to kind of come to terms with and grapple with, is that the long term is not just 1 year or a couple of years. It's a long term. And this chart builds on the last slide. Really what we've done here is just condensed down so you can see some of these drastic moves. And I'm sure most all of you have lived through this, because it was just in the last 2 years here. But a breakdown here again between, cash versus an all equity portfolio, and then somewhere in between. And as I'm sure you can imagine, the takeaway here is that, there can be the ups and there can be the downs. And in those time periods, there can be some whipsaw movements that happen very quickly and that happen very unexpectedly. But it goes both ways. A lot of investment movement and returns happen in very concentrated time periods, whether up or down. So we won't go down that rabbit hole, I don't think. But it's just important to understand that, when you're building out your asset allocation, one of the most important things to do is to try to get that right on the front end. And then you've got something that you're committed to and that you believe in, because it was set up and designed for you, not just some cookie cutter or boilerplate type thing. It's got to be right for you on the front end.
And we try to help a lot of our clients truly understand what risk are associated with different portfolios. And I think for the most part, it's tough to really grasp it, because you want a good return, but you don't want a lot of risk. Obviously everybody, what everybody wants. That's kind of the golden egg that really doesn't necessarily exist, but that's what people want. And so it's trying to help you understand, well, what does it actually mean to be invested in a portfolio that is globally diversified among all stocks throughout the United States and throughout the world? Let's say at 50%, or I guess since we're looking at it, 75% of it is in stocks and 25% is bonds. And a lot of people would say, oh, well, that's conservative. That's conservative. And, it's a lot more conservative than owning just one company that could go bankrupt, or it's a lot more conservative potentially than owning 50 companies that you just pick and think are the best. Now, the other argument we got into in part 2 is that you actually have just as high expected return by buying the entire market than just buying the 50 companies and less risk. So that's better. But how much true risk is there in a portfolio that has 75% in stocks? And it doesn't matter that it owns 11,000 throughout the world. You avoid the risk of obviously going totally bankrupt, and so you're not going to lose all your money. But it's very realistic to accept the fact that your portion that is invested in stocks will decline from its top by 50% over a period, a certain period. That's not unusual. That's not even weird. So like that, when that happens, you can't freak out and think I need to do something different, because if you do, then you were not invested right at the front end. And that's, that's where it goes back to, that's the ultimate determining factor of whether you're going to have a good result. Because if you tell me, if we can figure out that really what's right for me is 25% in stocks and 75% in bonds, then the market declines by 50%, you'd be down roughly 12%. And I would be okay I don't need to change, then you're invested the right way because you'll rebound how you should when things turn back around. But if you think you're okay with a 75% stock portfolio, you have to understand that it's totally normal then for your portfolio to be down 35% at its worst. That's not unusual. And you can't react after the fact it's down 35% and decide I really should have been more conservative, because then you'll never have a good return. And that's where, it's our job to help you really understand the risk that's being taken inside a portfolio so that you ultimately will have a good result as an investor. And that's the reason why the market returns what it's returned. So going back, it's returned, average 11% a year, something along those lines, dating back to 1929. That's a fact. That is what it has returned. If you had $1 and you put it in small cap stocks in 1929, you'd have, it's like $28,000, $25,000 today. So if you had 100,000, you'd have 25. I don't even know what that is. Massive sums of money. That's the fact. That's what's happened. The average investor's return is 3%. So the market's giving you 11, the investor's only gotten 3. Why is that? It's because the investor reacts after the fact when markets go down and they change their asset allocation. And that's where you lose. That's what happens.
Yeah, and so when we look at, what's the right allocation for you, but we look at it in a couple different ways. On the top, we've got something that looks like a speed limit sign. This represents, cash is one. The S&P 500 is number 77 here. And then, hey, maybe you're even taking on additional risk, Tesla at, 96. But we use this analogy of a speed limit sign, and that, look, under normal driving conditions and normal traffic and all that, if you're on the highway, you've got slow lane, the fast lane, and then in between. And some people are just naturally more comfortable driving in the slow lane, doing right at the speed limit, no matter what. And some people are just as comfortable driving 20 miles an hour over the speed limit, even if it's pouring rain. And investing, it's similar. People are willing to accept different risks to ultimately, get whatever outcome they're looking for. So that's why we look at it in those senses of, hey, what are you comfortable taking? What can you stomach? But then in addition to that, we've also got to factor in, well, what are your goals? What's your time horizon for meeting those goals? And then what other personal circumstances do you have? Whether it's personally, professionally, financially, all of these things wrapping up together ultimately help us arrive at the right asset allocation for you. And can you talk about, how much risk somebody needs to take relative to their expenses and the wealth that they have?
Yeah, there's just a lot of way to look at it, to look at it. And Mark said exactly, correct. Everything factors in. So you could take an example of somebody who's got, let's just use round figures. Someone has $10 million and they want to live on $100,000 a year. Okay. Someone with $10 million who only lives on $100,000 a year can afford to be invested however they want to be. They could be 100% stock. They can be 100% bond. Now, the likelihood is if they're 100% safe, they're going to have their money's going to be worth less and less as time goes on, and their heirs will get a smaller amount. But they still have no risk of running out of money. As to where if they're 100% stock, same thing. They could easily live the lifestyle that they want, but when they pass on, their heirs will probably, in most all likelihood, end up with a substantially higher inheritance. So that's where it's just up to the individual. And then for us to really dig in and understand, well, what it means to be really conservative or what it means to be really aggressive, and how can we make sure that you're comfortable. So that's one thing once you're retired and you've already got your pile of money. Most people aren't in that circumstance. Most people need their money to grow with inflation, and to grow more than inflation typically is what you want. And you're going to have to stomach, a certain level of risk that goes along with that. There's, that's, the retiree. Then there's the people leading up to retirement. And it's, well, what kind of job do you have? How secure is the income that you're making? And that also factors into how you can or should be invested. Because if you are a professor that has tenure and essentially you can't get fired no matter what you do, and I think it's guaranteed lifetime income, well, you can afford to be, it doesn't really matter how old you are. If you're living off that salary, you can afford to be invested more aggressively because you have a guaranteed income coming in for the rest of your life, which is ultimately what matters, because that's supporting your lifestyle. Versus you could be 70 years old and be in a whole all equity portfolio because you have that guarantee. It doesn't matter. Versus a 25-year-old, let's use as example Patrick Mahomes, who just signed a $450 million contract, right? Now that's so much money he can do whatever he wants to. But if you don't quite have that level, that sort of contract, but you're a young football player, well, your earnings potential is very, very volatile, and it's condensed to a very short period of time. So you need to have much more planning about how your investments are going to work relative to the uncertainty of your income. Or it could be you're in commercial real estate brokerage and you never know when the big deal is going to hit. There's no consistency of income. It can be very feast or famine. And that's where it's just all specific to you, and it all needs to be weighed in to ultimately what becomes your right asset allocation.
All right, well, let's lead into, additional opportunities when talking about asset allocation. And this is a slide that hopefully looks familiar because we touched on it very briefly last time. But just a reminder that, we live in the United States, and it's the market and the area that we're certainly most familiar with. It's made up of the companies that we're most familiar with and maybe even most likely to use. But this chart is a representation and a reminder that the United States still makes up ultimately just a portion of your overall opportunities in investing in global equity markets. It's a little more than half of global equity markets is the United States. The remaining half is in other countries that you're also familiar with, and made up of companies that we also know. So whether it's Japan or Germany or France or Switzerland, what we call international developed markets, or even emerging markets like a Brazil or China is an emerging market, or India, or many others. When we put together a portfolio, when we look at asset allocation, certainly investing in the United States is important, and we even have a small home country bias for a few reasons. But it doesn't mean that we exclude the rest of the investment landscape, and nor should we.
Well, right. And the reason we don't is because of expected returns in the future.
Mm-hmm.
I mean, it's not because we love investing in, Taiwan, and we just really think there's an incredible opportunity in their equity markets, or Israel or Spain or Britain. I mean, it's all about combining investments to give you the highest expected return for the least amount of risk. And so you incorporate those other investments simply because mathematically that is the case. That's a mathematical fact. So it would be malpractice for us to just exclude that and think that we're going to guess which market's going to do the best in the next year or the next 2 or 3 years. And so we do have what Mark mentioned, home country bias. And what that means is, we live in the United States. So a home country bias would be having it's with our portfolio. So the United States stock market makes up 54% of the world stock market. It makes up 70% of our clients' portfolios, simply because, one, we're here. When you look at what happened in the market in the day in, day out, you're going to want to see your portfolio reflect that to a certain degree. And it becomes difficult if, the U.S. market is up 10%, the international market is down 10%, you're flat or negative for the day. You're going to not, you just won't be comfortable with that. That's not just true in the United States. That's true everywhere in the world. If you go to Japan, What do you think their portfolios look like? Do you think they're weighted way more to the United States? No, they are very heavily concentrated in Japanese stocks. It's Australia, same way. It's that way all throughout the world because we want to invest in what we see and what we know, but we don't want to do that to the detriment of expected returns in the future just because we aren't emotionally comfortable maybe with how it is. And so this is what it's meant. Like, this is why we do it. But there was a 10-year period where if you had started with $1 million and you put it in the S&P 500, at the end of that 10th year, 2009, which would have been 10 periods, you had 910,000, 909,000. You lost money, not to inflation, not to purchasing power. You actually had a negative return, as to where if you were invested only internationally, you would have had your $1 million would have been worth 2 million. You double your money. So you would have been $1 million behind, at the end of that period. Now, the subsequent 10-year period, the opposite occurred, right? So $1 million would have been worth 1.7, as to where $1 million would be worth 3.5 if you were investing in the United States. So it's another example of why you don't ever invest based upon what has happened, because what has happened tells you nothing about what's going to happen in the future. If I would have come in from wherever and fallen into a ton of money, and I decided, well, wow, I mean, the U.S. stock market's dead. It's lost money over the last decade. I mean, I'm going to put all my money in to the international markets. The following 10 years, the exact opposite occurred. So you just can't accurately say, oh, this is what will happen, because this is what did happen. You've got to factor in mathematically to build the best return. And then if you combine the periods together, they've kind of even out, but you've actually still had higher returns than by being internationally diversified. And the more important factor is, the returns have been the same over the last 20 years, but by incorporating those other international assets into your portfolio, you had less risk and you got the same result, which is obviously a good thing.
Yeah, a better risk-adjusted return.
Yeah,
I mean, that's what every investor should want.
Mm-hmm.
Yeah, so the lost decade here, 2000, 2009, is just a great example. It's one that we lean on often, especially in a time like now. The S&P 500 has been absolutely on fire for the last several years, and arguably, one of the top performing indexes anywhere around. I mean, if you were just in that the last couple of years in particular, you'd be incredibly happy. But as Kenny rightfully mentioned, it just gets back to this idea: you can't look back to determine what you should do next. Because it's not an exact indicator. It's all about spreading your bets around, so to speak, and diversifying. And look, there's a great quote that I like where it says that diversification means accepting that you will be wrong. And it seems kind of opposite to what we're talking about here, all the benefits of diversification and why it's literally one of the pillars that we believe in and always will. But at the same time, what diversification means is that, you're going to own some of the great winners and some of the ones that fall short, but we just don't know when those will come and where. And so to that point, here's a few examples of, to the left of the line, investing in the United States versus abroad. If you are willing as an investor to own Ford, the company Ford, why would you not be interested in owning Toyota or Volkswagen Group? Same thing if you like Campbell's, why not Nestle? Or in the financial sector, if you're into Bank of America, well, why not SoftBank? Just because they're domiciled somewhere else doesn't mean that they shouldn't be considered as investments in your portfolio.
A lot of these companies obviously do a lot of business in the United States.
Mm-hmm. Yeah, and as markets, become increasingly global, I think that lesson becomes a little bit more apparent. Certainly, with the diversification of revenues, you can't go outside very far without seeing a Toyota drive in front of you. So that makes sense there. But I think we pounded those points home a good bit today, and hopefully for good reason. And so ultimately, I think this is a great quote that sums up what we're talking about here today when it comes to asset allocation. Look, ultimately, There's been studies that have shown that asset allocation is going to be one of, if not the top driver to your ultimate returns and performance and success as an investor. There's a whole host of other things like how do you control expenses? How much money do you actually save? What's the tax ramifications of what you're doing? There's a lot of things that go into it, but ultimately asset allocation is one of the very most important to consider.
Absolutely. I mean, I would say it's the primary reason. If you look back 30 years from today, going 30 years forward, and you can look back in the future, your return is going to be most likely derided by the amount of money you have in stocks versus bonds.
Mm-hmm.
The up and down, and if you can stay relatively consistent with that. And so we rebalance, and that means buying, if you have 70% stocks and 30% bonds, right? Stocks go up to now they're 75%, and now your bonds are 25%. Well, you sell the stocks to bring it back to 70-30. If you can stay, in whatever portfolio it is, whether it's 10% stocks, 90% bonds, or 90% stocks, 10% bonds, whatever it is, as long as you can stay disciplined in that overall asset allocation, your return has a very, very, very high likelihood of being pretty good. It's when you start messing with that and you start to make emotional decisions about your asset allocation, which ultimately can mess up returns.
That's it. A great summary there. So this webinar will be posted on our Bear Facts here sometime later this week, as well as all of the other content that we've been putting out. So encourage you to check that out and let us know what you are enjoying, what subjects have been of interest to you, and you think that we've done a good job, and let us know what questions you have and what other topics you'd like us to cover, because we'd be happy to do that as well. And if you have any questions about your investments or what you may be doing currently or think you should be doing, then give us a call. We're here to answer those questions and to help you, as well as those who you care for. We're here to help them. So let us know. And with that, that's what we've got for your investments part 3 today. And we appreciate everyone tuning in.
Absolutely.